Welcome to today's episode of Heartland Market Talk on the open range. Well, headlines do have oil rising today after struggling. Had peaked out here prior 2 weeks ago with the push to $88 as there was fears of Middle Eastern unrest if the Iranian Israeli war picked up too much heat, but it seemed to be just tit-for-tat fighting is what's been going on. The oil price had declined to near $80 a barrel early in today's session, but has now found a big rise off that as we have a lot of economic data coming up later this week. On this same fall on fears, gold prior to 2 weeks ago's concern with what happened on the Hamas attack of Israel, gold rallied to a price we talked about, $2,450. Now it's seen a big tumble as of late, largest multi-day tumble we've seen in 2 years. But not tumbling is Wall Street, recovering here from recent corrections. We have a lot of earnings report coming out later this week, along with the big Federal Reserve decision on May 1st, which we do know will not have any interest rate declines in it. But what we're watching for is the communique that Fed Chairman Powell has afterwards. Sometimes they pick apart his words to see if we have something coming maybe in the summertime or sooner than September. Now it's time for Heartland Insights. We're going to start with Kansas City wheat today, notable, but in a decline for 2 years. More intense decline since December last fall. The decline has now seen a trend line breakout. We've noticed this for you last week, but it hadn't gone anywhere. While today's actions follow through from Friday and Monday's sharp gains, waking the trade up. And what it's tied to is the dryness on the Russian wheat belt and Ukraine. I'm highlighting the area just above the Black Sea where the wheat is grown. I'm going to show it to you more specifically. When you look at Russia, where their total wheat production is, 80% of that crop is in this range right up next to Ukraine. Here is the Ukrainian border. The Black Sea is just to the west of this here. And so all this wheat is grown in here. The Volga, the Central. Siberia is only 13%. The Urals are 4%. And way up in the Northwest, 1%. So we have a large production of wheat here. And again, I'll show you this chart. This area of dryness has become concerning for Russia and up into Ukraine. And they have now been 6 weeks without any reasonable moisture. It's been dry, warming to the 70s and 80s this week, with no rain as far as we can see out for 15 days. And they will start jointing the wheat and reproductive stages. And so they need that rain to come. This is what's woken the wheat market up a little bit. Also, Kansas, still the large area of Kansas remains dry. This is the forecast through Friday, May 3rd next week. Large areas, we're seeing the crop ratings now slide as with Monday down 5% from what were reasonable ratings here just 2 weeks ago. And when we look to Minneapolis spring wheat, even there too, downtrend line being busted, and we are now moving to the upside. Now, how much movement is totally dependent on, are we going to get a forecast of rain or not? It's truly a weather market. Sometimes you think you know what the weather is, but weather will change its mind without your notice, and then we tumble. But the wheat market is extremely oversold with this large short position set up by the funds. A substantial lift, even in the Minneapolis wheat contract, is capable of occurring to the $7 handle, if not a little bit higher yet, because they are so oversold and so heavily inundated with the short trade from index funds who will quickly buy their positions back. Corn in this bounce over the last few sessions, recovering almost to the March 31st recovery high when we had that friendly data from the USDA dropping acreage as much as they had. Well, it's key that we see more strength for a day or two because this moving average resistance is what a lot of funds will watch. 2 days on a closing basis above the 452 range for July corn could bring in new technical buying that could equal this move here. We call it measured move theory, and we could see a move like this up to the $4.80 on July corn. Soybeans, just like corn, up to moving average resistance. A couple more days of strength could as well see from a double bottom the index funds worried about having such a large short position put in place since last December as you head into a new crop year. Unknowns abound moving forward that can get some kind of short covering bounce on this soybean trade, with July beans possibly challenging the $12 mark, if not higher. Now let's get to gold. Gold had made a spectacular rise 2 weeks ago. It's tumbling hard over the last 3 days, the largest 3-day break from yesterday's high in 2 years. Note that when this show started, we had witnessed the breakout of this gold market above 4-year resistance. And we trained you about how you take 4 years worth of congestion that gives you a range that you can target above as a movement to the upside. And we have projected for you 2,450 to 2,500. got to $2,448.80. Close counts and horseshoes, hand grenades, and commodity markets, and now we've done a retreat. Now keep in mind, when you get these breakouts and achieve targets, you can see a market pull almost back to its breakout point and then make its next move again. Now seasonally, gold typically softens in the months of May, June, July, and August, bottoming sometime in August. So be aware that we've made a substantial move on the gold market, and a retreat could be in the offering. In crude oil, we're seeing the pullback from those highs, just like gold, but the pullback just above our winter resistance, which was just under $80. Today's low was just above the 80 value, and now we're turning back up again. We'll see if we can continue our seasonal advance as crude oil, even on the weekly charts. We look at it on one bar is a week. We broke out several weeks ago, pulled back, and now we're challenging it. If we can hold, we will continue our seasonal lift from December into May or June when crude oil has a tendency of peaking out. We typically look for the crude oil market could probably rally back to the $90 value to find a top side. The dollar, stagnant, and will have an effect on the trade after May 1st. It's now time for our question of the day segment. We encourage our viewers to email info@heartlandinvest.com any question you might have for the marketplace, whether it's in the stocks or commodities. We'd love to answer them for you. So we had a question come in. Does the futures markets directly affect the cash commodity markets? Well, the answer is yes. That is why they were invented. Now, there is a difference called basis. Some areas of the country, as the corn market, for example, is rising, corn cash prices will rise, but there may be more corn located in one area of the country than another area. So the area where there's a lot of corn, if corn went up, for example, 20 cents, the cash price basis may only allow it to rise 18 cents. Now, in areas where there's corn in shorter supply and the futures price rallies 20 cents, that basis may add an increase in value. So maybe corn in those areas will rise 20 to 22 to maybe even 24 cents. So basis is a regional thing, but the futures market is generally anticipating what the cash trade wants to do. Again, questions go to info@heartlandinvest.com. Remember, you can always call us at 701-222-0221 or visit us online at heartlandinvest.com. While you're there, don't forget to check out our Heartland Market Talk podcast and sign up for our daily newsletter. And for producers, remember, we offer crop and LRP insurance as well. Thank you for watching today's episode of Heartland Market Talk on the Open Range.